I am Jim Costello. I am head of real estate economics and chief economist for MSCI Real Estate. So I was in a panel just now here at the IREI VIP event where we talked about valuation issues. And three key areas I wanted to talk about were prices and prices relative to longer term trends, what's happening with cap rates, and are they sustainable at low levels given that there's some inflation? And then the last topic is something about the industrial sector, and people are concerned, is it a bubble? And I have to say, for me, bubble is fighting words. So on the topic of prices and where they are over the long term, commercial property prices are at a record high. And when I say it's a record high, there's some fuzziness around that because real estate is not like the stock or bond markets. I'm with a data company, so I can say this, but real estate data is crap compared to other asset classes. Only since the 1970s have we been able to start collecting data in an organized way and put it in databases. You go into other asset classes, and they've had that sort of information for years. But there's some earlier survey-based stuff, and if you look at kind of splicing data together, you can get a view back 100 years or so. In Manhattan, a colleague of mine, Bill Wheaton, he's a professor in economics at MIT. He did a study looking at old records from the Real Estate Board of New York and figured out the commercial property price trends. And I spliced that into our current index, and Manhattan office prices have never been as high as they are today, even considering that prices have come down a little bit because of the pandemic. So there were some structural differences in the most recent boom relative to all that history. You had more of a focus in this area, but also just you didn't have the ability to continue to sprawl further and further out. Prices were reduced over a very long period of time in the United States for commercial property because we had this expansion into the suburbs. We had a new introduction of a new technology. The technological change of highways and cars allowed urban areas to spread out. And as you do that, you're reducing the land cost for the economy overall, and you're getting these more suburban assets. But we've reached the limit on that for the most part. We're not, for the most part, building new ring road highways in most urban areas in the United States. We're not really spreading out as much anymore. And so that increases the price level inside. It's an unusual situation, but it's not as if suddenly that's all going to mean revert and we're going to go back to the average level that we saw from the 1970s on. And part of it is like we're not suddenly going to introduce new ring road highways. There's higher energy costs today. People are becoming more aware of the carbon costs associated with travel. And so more of a concentration will help provide a bit of a lift to property prices. Combine that with sustainability for property prices, rather. Combine that with, like in the apartment sector, we've made it largely illegal to build apartment units in large parts of the United States. So it is, there are supply restraints there. They're not driven by the market, but driven by overbearing regulation. So cap rates, though, that's the second topic I wanted to talk about. You have a situation where there's a little bit of unease we've had around interest rates because we've seen some inflationary pressures. There's more announcements that the Fed is thinking that in March they may have to start tightening things up compared to where they were. So there's a concern that, hey, if interest rates go up, cap rates go up too. And then all these high prices we paid don't make any sense anymore. The challenge with this is that people look at the increase in interest rates and they figure, well, if interest rates go up 100 basis points, I need to add that 100 basis points to the cap rates I'm using today. And prices will fall dramatically and we're all dead. But that's really not the way it works. They rhyme, cap rates and interest rates, but they never move in a one-to-one fashion. Interest rates and cap rates, there's a spread between them that moves with investor perceptions of risk, and they also move with investor expectations around future income growth. If interest rates are increasing, but investors expect stronger and stronger income growth, not only can that spread narrow, there's times historically it's gone negative. Now, there's an issue about whether it's a rational expectation or not, but a real good example is in 2007. If you look at both London and New York, cap rates for CBD offices in those locations were lower than their corresponding 10-year government bond yield. those areas, were dead center for the growth in the global economy that we saw in the '05 to '07 period. So investors are underwriting that that would continue forever. Now, bubble is a fighting word to me. As an economist, I just don't like that word. But people were using expectations that were poorly formed around income growth. And so it drove cap rates to such low levels. The industrial sector, that's my segue to the industrial sector, cap rates are at record lows. They're now lower for warehouses than for CBD offices. So it raises that question. Are investors underwriting improperly? Are they being irrational today? It is a change underway in the industrial sector. You have a record high pace of construction, but along with that, you're getting a record high pace of property price growth, 30% per year in 2021 for industrial properties. That 30% came with income growth of only 6.7% for our same store NOI index. So there's a lot of change there where the change is coming from investor perceptions, just willing to pay more for a dollar of income. And they're willing to pay more for a dollar of income because they see strong rent growth, they see it continuing, they're underwriting that. And they're doing that because of the change in the nature of the industrial market. There's much more of a focus on that shift in consumption activity to online services as opposed to in-store services. And so that change, people are underwriting that and bringing it into their expectations. Now, is it rational? Well, in the near term, yeah. There is a transition there. They're not pricing it so aggressively that cap rates are lower than interest rates. It's not like that '05, '07 period. There's still a spread. And as interest rates go up, that spread might narrow if they continue to be excited about the sector. And for the near term, the changes that have been happening to consumption activity, more of it moving online, until that hits some sort of plateau where we've reached the balancing point of here's what the mix of the economy needs for shopping in store, and here's the mix for what they want online. Until we figure out what that balance point is, people are going to continue to be thinking about growth. And we come to some point when we hit that balance point, and some people are worried that, hey, will we hit a point that the market overshoots, that people expect 40% consumer shopping online and that only settles at a 30% level. I'm not predicting those levels. I'm just throwing that out there as an example. But if you have that happen, will we then be in a bad situation where people got ahead of their skis on industrial and they built too much? And there we're a little bit safer for industrial in the sense that when the sign finally comes that we've hit that balancing point, you can shut down construction quickly. It's not like starting an office building. I live in downtown Brooklyn. Where I live, big office building started just before the pandemic. It was clear that it wasn't as needed as it was before. However, you start, you gotta go with that. An industrial building where it's tilt-up concrete walls and a concrete slab, it's a shorter construction time frame, and you can start and stop it easier. So if we do come to that point where there's a sign that we're building as much as we need, we don't need to continue introducing as much, the supply chain has worked itself out, the construction levels we're seeing can taper back very quickly. So those are the main things we talked about on the panel, at least the ones I can remember at this point. But it was a fantastic event, and hopefully I can see more people at the same event next year.